Hey everybody, welcome to the Rochester Real Estate Show. Jason Mancuso here, and joined again today by Steve Bentivegna, the Anthony Butera Team, Keller Williams Realty. How's it going?
I'm good.
Yeah?
How are you?
Can't complain.
Yeah.
Can't complain. It's a good answer considering all the the news headlines floating around there in recent months. And I think it's a good time to, it's funny. Recent years, like it's just the topic of like what's the state of the union real estate market wise has been beaten to death, and always a conversation around the seller's market and what you have to do as a buyer to be prepared for it, how to act accordingly, right? So hopping back into that topic, which is overdue at this point given everything that's happened in the last few months, and even 2020 2022 so far this year. We're creeping up on the halfway point. This is what are we at? June 29th today, 2022. So to catch you up to speed, I guess if you just woke up from a coma, right? A couple months ago now, right? Interest rates jumped dramatically. The climate economically that we've been in so far this year, inflation is the hot topic. Just the cost of everyday goods and services for the everyday consumer is on the rise. Gas prices specifically, as of today, we're right around $5 a gallon. Just everything cost wise is on the rise, and it's kind of not necessarily by design, but what's by design to combat that from the government perspective is to raise interest rates to essentially cool the
spending.
The spending that has in large part caused costs to rise because suppliers can get in their way, right? So it's all the State of the Union conversations for the past 4 years or so has been you can ultimately come back to it, the classics fundamentals of supply and demand, and we're still within that conversation, right? So costs being on the rise due to high demand and supply being limited, and therefore the people on the supply end of it have the ability to charge more in a way, in addition to just but there's all sorts of factors. I don't mean to make it go down a corporate greed type of rabbit hole, but here we are. So the Federal Reserve response to the economic dynamics in play is to raise interest rates across the board.
Make it less easy to borrow money and use money, because that's as interest rates were super low.
Right.
It was so easy to get funding and so cheap to get money, I should say.
Yep.
So who's not trying to get money?
Sure.
Where we make it more expensive, it'll slow everything down.
Correct. Hopefully the intent is that hopefully the effect that ultimately has on everyday, Johnny consumer is that it drives the cost down, because the last thing that the government or any government would want is, an 8% inflation rate when they're targeting
keep
2%.
Continuing.
Yeah. Right. I mean, generally speaking, 2% inflation is acceptable and like the target. Mm-hmm. So even though we're only going for 2 to 8,
4 times.
It's significant, and it's going to have an effect on the everyday, just person trying to live, right? I mean, we're
everyone's feeling it.
Everybody's feeling it at this point. Just even if you're well off or whatever you want to call it, right? It costs you triple to fill your tank of gas. From what it
doubled it to just about anything else.
Yeah,
right?
and a lot more to just buy your bread and eggs and everything on that side of it. So we talked about interest rates. It's important. We've talked about this before, but just what the Federal Reserve does not necessarily. It's not like a direct correlation to mortgage interest rates, but it's definitely plays a role. So. Haven't talked about this yet, but we've got a war in Europe and Ukraine that's kind of caused a lot of economic concerns too, and restraints and things of that nature. So really right about when that started, the war that is, Russia and Ukraine,
Add to the pile.
that really kind of, almost threw gas on the fire. Mm-hmm. And then the mortgage rates responded pretty much in line, with that news cycle and really started to creep up. Mm-hmm. So here we are, and I mean, important to recap the last few years, like, COVID happened 2020, and, one of the responses was to dramatically lower interest rates to a historical all-time low. At one point, high 2% on a 30-year mortgage interest rate is like, man, if you bought during that time and locked in a 30-year game plan and, you're staying in the house for that time too at 2.875 or whatever you got, I'd be willing to bet that's never going to happen in our lifetime again.
Yeah, probably not.
And that may be a dangerous statement in terms of our lifetime, but that was cause and effect. I mean, that happened as a result of mainly COVID, right? So hopefully this isn't a recurring thing over time, right?
Yeah,
but
sure.
assuming we don't head into a pandemic ever again, or something similar in terms of global life and economic, consequences. Disaster, exactly. Hopefully, I say we don't have the response that leads to a 2.8% mortgage interest rate. Okay, so fast forward to this year, we're now sitting right around 6, high 5s for that same 30-year mortgage product that somebody would have gotten 3 at, now is 6 for, give or take. I just spoke with our loan officer earlier in the week, and they're sitting around, 5.8, 5.9. So call it 6.
Makes a big difference on your monthly payment when you're looking at the same price point. A huge difference, and we're starting to see the changes in the market.
Big time, right? Yeah. So I mean, back to supply and demand. This higher interest rate inevitably has to have an effect on the demand side of things, right? Mm-hmm. Just because when you essentially, it's not a direct double of terms of what the cost is for a buyer, but when you double the interest that they're paying,
it's a big difference.
It's a big difference, and it's going to have an effect. And it's played out to where, say a buyer who was targeting a $200,000 home, may now only be able to target 160.
Yeah, right.
Right.
160. Not to mention everything you mentioned before with the cost of living in general going up. Mm-hmm. So not only do you qualify for less for your mortgage, but everything costs more money. So generally speaking, you don't have as much.
Well, or it's starting to dwindle, right? Or you're starting to tap into it more because one of the news headlines, so to speak, as an effect of the last couple of years, and whether it's just been somewhat of an economic boom after that, March of 2020, deep decline, the world is ending, and then by the summertime,
things were pretty good.
Yeah, boats and hoes in the summer, right? I mean, it's just there was in a lot of industries anyway. They quickly pivoted and figured out how to not only maintain the level of business, but capitalize even more. Mm-hmm. Good for that, right? Good for everybody involved. So there's long-winded way of saying there's been a lot of consumer savings at an all-time high too over the last couple of years, which is now hopefully everything's kind of at worst anyway, a zero-sum game in terms of all the money you saved the last couple of years gets washed away by higher gas prices and everything else. Hopefully this doesn't cause a decline from the situation. If you're using 2019 as the baseline. Does that make sense? But ultimately, people are going to have to spend more on just, again, getting to work every day or every week, whatever. Tank of gas is double or sometimes, triple, depending on what kind of car you're driving or whatever it is, right? So that has an effect too in terms of overall affordability. So it's pretty obvious what's happening right now is going to have an effect on the demand just from a general, well, I don't need to move and therefore I'm not going to pay that interest rate compared to what I know it was. Like I'm not going to call that stubborn, right? Like just having that short-term memory affect your decision making in the sense that, knowing that the interest rates were so low just a short time ago and seeing what the huge jump has been in a short time as well, I could totally, understand the consumer mindset of like, I don't need to move. Let's take a time out, see how this plays out, right? So that's going to be effect, and then the overall just like a practical, realistic affordability for people is going to be in effect too.
Sure.
Before we jump into like supply side state of the union, like let's talk about buying. Let's talk about the demand. I mean, what's your? I just rambled a lot. What's your take on things? What are you seeing out there? Advice for buyers, things of that nature.
Well, I think it's important to point out that, like you just said, that buyers may be looking at the interest rates and saying this may not be a good time to buy.
Right.
But last year, when interest rates were incredibly low, there were still buyers saying this may not be the best time to buy because the prices are ridiculous, right? I think that there's opportunity in any market that you're in. You just have to have the right plan for it. And, a year ago it was, you may have to pay $50,000 over asking price for this house, right? But you're going to lock into a 2.75 interest rate for 30 years. And I've done the math with clients that have purchased during that time and just kind of give them the good news of, hey, I know you paid actually more than $50,000 over asking price in many situations. But with the interest rate that you have right now compared to today's interest rate, your payment would be an extra $500-600 today for the same house, or you would have had to get the other house for $90,000 cheaper to have the same payment. Right. But fast forward to this market here, and there's also opportunity as we move forward into a market that's not quite as hot.
Right.
Still a seller's market, right?
Yeah.
We can all agree there. It's still a good time to sell.
Mm-hmm.
But for that same house that was getting 20 offers, might only get 2 or 3 offers. You got a better chance of getting a better price on it. I'm sure your interest rate is higher, but who's to say you can't refinance down the road when they drop again?
Yeah.
So you're not married to the interest rate.
Yeah, that's been a line, on our side of the business that's come out a lot lately. With everything going on, is like, marry the house, date the rate. And I get it. And I think, as agents on our end, like, sure, we can give that example of a piece of advice. I think we also have to back it up with, like, you got to understand how historically low the rates were.
Yeah, don't plan on 2%.
Yeah, if you're just expecting to refinance at 3%, that may not be available to you.
Sure.
If you're able to catch a refinance where you're getting a lower rate, 1.5% or so, I think that's kind of a reasonable expectation of being able to time it up like that. I think people also have to understand in that example of like, okay, I'll get into a higher rate right now, but refinance later. Like, it's not free. You have to.
You pay the closing costs.
Yeah, you have closing costs, or you have, you end up taking out a higher loan balance from where you were before to account for that sort of stuff. But, just I wanted to address that because it's certainly a valid concept, but I think it's already, in the few weeks I feel like it's been thrown out there. It's already kind of getting overplayed to where it's just, everybody's saying it in our industry now. And it's like, okay, yes, but let's make sure we're calculated here, right?
Sure.
Yeah, I mean, you made the point of like people that have bought in the last couple of years and the pricing that's been going on, and then looking at the the cost savings over the long term, especially. I guess in a perfect world, like we're coming from the goal aspect of if you bought in the last 18 months, 24 months, whatever, we're really hoping that you're not selling in the next 12 to 18, 24 months either. And those are conversations that we've been having.
Oh, 100%.
Right, because from there it's like, all right, we know, the bidding war, the competitive situation, the the data that we can't bring to the table to justify paying this price that you're about to pay. So just don't do it if you're only here, like we
couple years.
We deal with a lot of like a lot of, with U of R and Strong, a lot of, people that are relocating here to get into that program and just plan on being here for the tenure of their education and then back to New York City or whatever it is. Not telling you not to buy a house.
I'm just informing you before you do it that this is risky. If you have to resell.
I shouldn't even say what I just said, because I tell people all the time, like if I get into like, asking questions, interrogating like the situation and make sure we're properly representing them. And one of the questions is like, okay, you're going to buy a house now, you're going to live in it. I understand it's, you're making an investment for that time period, a few years while you're here in comparison to what, it costs to rent something in the area you want to be in or room or board, whatever the example is. Right. But, okay, are you going to keep that house after you move back to New York or Boston or whatever and rent it out and keep it as an investment?
With that low interest rate,
right.
That would work out real well.
Yeah, that would work out great. If the answer is a hard no, I want nothing to do with real estate investing. I don't want to be a landlord. I'm in Rochester for 2 years. I just want to own my home, not have to deal with a landlord. Again, it's not like don't buy a house. It's, okay, we can't predict market cycles and how they play out. Are you going to be okay if you don't have any equity / may even have to cut a check to get out of the house when you want to sell it, when you're done with your tenure here?
Yeah.
That's a conversation I'm not afraid to have.
No, definitely
right?
not.
Because it's like, look at if you just think everything's hunky-dory and like we're going to continue on with, a certain level of appreciation, it's risky.
That is definitely risky,
right?
Especially with the way everything's been going.
Generally speaking, like I do, I believe in economic cycles, right? So, not even to the tune of like what goes up must come down, but just a cycle in that like there's a good side of things and then there's a either bad, which may be what goes up must come down, but a not so good, right? Or just running through, the high may be met with the other end of that being like, not as high, right? And if you're banking on getting into a house for 2 years and then selling it for more, in any market, that's a risk because that's so short of a cycle that it's tough to make predictions for next week and 6 months from now in our business, much less 2 years.
Yeah, you're going to keep the place for 20, 30, 40 years. You can look historically, the values are going to go up over time. It's just going to go up, down, up, down, up, down, up, down. But it's going to trend up over the time.
Correct.
Right? That's where you're getting at.
Yeah, and that's the other side of that example. And then like, okay, if you're only buying plans to live in a house for a couple of years, the other side where it's an easier decision and less of a gamble is like, look at this is going to be our forever house. We have no intention of moving. Sure, from there, life happens, whatever. You have more kids, you need more space, divorce, death, etc. All these, negative things that kind of cause, homes to always be, bought and sold, right? But it's just, we can talk to you in that light of like, hey, look at, okay, 30 years from now, like, at that point, like, hey, I'm thinking the worst case scenario is that your house is worth the same. At that point, you don't have a mortgage, so you have an asset now.
Right, yeah. I will say that, and I do have those same conversations with clients, and I've sold a number of houses over the past couple of years after giving those examples. I'm saying we're probably only going to stay for a few years, and And a lot of times it can be justified still with, all right, well, I'm putting 30% down, so at least I'm safe. I'm not going to be like in real trouble, right? If the market dips. And living isn't free. So you're renting, you're giving the money away.
Paying somebody else's mortgage.
Right, exactly. So it still can make sense for the right person. But yeah, that's definitely a conversation that we have with everybody for sure.
That person who doesn't want to take on any risk in life.
Yeah, good luck.
Yeah,
but
in any market or any example, like buying a home is a tough thing to chew on, right? Because it's more or less, it's not permanent, right? But it's not a car, it's not a pair of jeans or whatever, right? If you don't like it, like you got to make sure that you're in all the way as much as the game plan suits you.
One of the first questions, right, that you ask a buyer is, "What is your plan?"
Yeah.
And frankly, a lot of times the answer is, I don't know.
Yeah.
So we talk it through with them and come up with a plan. And you have to have some kind of an idea to hedge your risk. If you know, like you said, in any market, any market, it doesn't make a difference. You got to have at least know an idea of what your plan is, how long you're staying and moving forward in the future. So
you have to plan it out. And I mean, I think this is what Steve Popovich and I talked about last episode was like, okay, ultimately you still, as a buyer, okay, this market that we're in now, as a buyer, now what? Well, it just starts with that plan. Like, what are your goals? What are your needs? What are the financial capabilities? Where are you comfortable? And then we go from there. So even with double the interest rate that we're dealing with right now and for the foreseeable future, the beauty of it is it all remains the same in terms of the approach. Not saying that there's not going to be differences in affordability, because there will be, but it's just, where do you want to be? And okay, here's the fit for it. And let's make sure you don't go outside that comfort zone. And what's going to happen more and more in this market as it evolves is just, okay, great, this is what I can afford, here's where I'm comfortable, but I don't want that house. I don't want that neighborhood. And the needs and the wants are going to be more dwelled on more in order to make decisions than ever because of the economic climate that we're in. Because it's going to quickly become, if it hasn't already, and I would probably argue that it has, but if you want to buy a home and don't need to,
you got some things to think about.
Yeah, you got some things to think about, and this may not be the time to pull the trigger, right?
Yeah.
Now, if money's not a thing and there is no affordability question, sure, do whatever you want, right? Generally speaking, any phase of life, right? But
God bless you.
Yeah, no, exactly. But for most, it's okay. At least with our approach, is like, all right, a lot of it hinges on the financial comfort conversation and this interest rate aspect that's going on, and the economy and the inflation and all that is a big driving force that has an effect on that side of the decision making process financially, because if none of us were doing anything financially savvy, and we're just, I love that house, it has a sick pool and sick kitchen, let's do it. A lot of people would get into trouble once they realize they can't afford it, right? So yeah, I mean, rambling about this topic of higher interest rates at this point, which is needed, because this is the state of the union right now, halfway through 2022, especially on the buying side.
Sure.
Anything to add on the buying side?
Opportunities as the interest rates go up, especially for cash buyers, right?
Sure.
I feel like there were so many cash purchases over the last few years, whether it be cash guarantee or whatever, to get the house.
Yeah.
But that was your advantage as being cash, of getting an accepted offer, and it wasn't all that much of an advantage, like because of the cash guarantee type offers that are out there. But moving forward, as interest rates are higher, I mean, I think you have more leverage, right? I mean, and if you can get a better price on it because there's less competition, cash is really king going into what our toes are wet in already.
Yeah,
right? I mean,
absolutely. And I mean, on that side, like just to touch on it quickly, like back to inflation, it's in the textbooks of real estate being a hedge against inflation. Just from the standpoint that if you're making real estate investments, typically it's for, long term, quote unquote, right? And, you ride, like you referred to it, you ride the waves up and down, but generally speaking, you're heading up over the long term.
Mm-hmm.
So
even if you buy at the bottom of a dip,
right,
over the long term, you should be okay.
Right, yeah, exactly. Or at the top.
I guess that would make more sense. That's what I meant. Yeah,
at the top, and then it dips, and then it goes back up. Yeah, exactly. So with inflation, essentially the concept is that like your cash is worth less if it's just sitting in a bank account, because you're having to spend it on more expensive things for the same set of cost of goods. But if you invest that same amount of cash into real estate, well, sure, I mean, the values of real estate may go down for a period and then come back up. But I think the assumption is if it's an investment property anyway, you're making cash on it, more so of a rate of return than what you would with it just sitting in the bank. And potentially, inflationary periods may lead to a rough stock market period and more money being made than that sitting in your 401k or IRA or whatever, too. Sure. But if it's just your home too, like, as you put it, like you have to have a place to live.
And as there's
you have to pay for it.
100%. Yeah.
So, it's an aspect of investing that real estate is a hedge against inflation. And, if you're cash heavy, then
buy real estate.
Yeah. Like in any market.
Yeah, always. Yeah.
With the long-term objective anyway. So.
And as demand goes by for buyers of real estate, I mean, they have to live somewhere, like you said. I mean, is the demand going to go up for rentals?
Right.
I mean, own rental property.
Yeah, exactly.
It's always a good time, but
yeah,
if you're talking about advantages going into a different market,
right.
I mean, it's
a
good thing to do.
Absolutely. All right, so I don't know how doom and gloom it may sound, but painted a doom and gloom picture around the buying side of things.
I'm trying to brighten you up, EJ.
Well, you mentioned we're still in the seller's market. So if I'm, just getting my 101 education on real estate from this show today, how the hell could we be in a seller's market still when we just talked about all this effect on demand? Right?
Still not enough supply. No matter what it is, there's still a lack of supply.
Yeah.
So people can keep buying.
Even with demand being significantly reduced, if we want to call it that, still not
still not enough.
Not even in imbalance. Mm-hmm. Yeah. It's really just it brings to the forefront how extreme the market conditions have been since 2017. To have everything that's happened this year so far, and to have it not be balanced at this point, much less a buyer's market, right? Because if we think about let's just define supply and demand in a seller's market or a buyer's market as just for proportion relation's sake, is like there's 10 buyers for every one home in a seller's market, right? And if it were a buyer's market, there'd be 10 homes for every one buyer. Yeah,
we're definitely not seeing that.
A buyer can go out and have their pick of the litter.
Yeah.
In balances, there's 10 homes and 10 buyers. We're not seeing a balanced market yet, and we're not seeing a buyer's market. How friggin' crazy has this extreme inventory drought causing this seller's market been in the last going on 5 years?
Yeah, you mentioned 2017, and just thinking back, it just makes me laugh because what we thought was crazy, and what people were paying for houses, it's like, wow, this is insane.
Yeah,
I mean, it obviously exploded from there. So
COVID threw the Molotov cocktail in the whole market, right? Which is just crazy to think. I mean, we can justify the reasons why with hindsight, but it's like who the hell? March 2020. March
No,
2020.
no,
We were like, all right, what career am I going to get into now? Are we even allowed to sell real estate right now? For the first week, it was like, okay, how are we going to show houses? How are we going to do this? How are we going to do that?
I was ready to deliver food, whatever.
and then the market just went absolutely even more insane. And that's a perspective that doesn't get talked about enough in our industry, and bringing it to the consumer especially. Like, people have to realize 2020 and 2021 nationally, probably globally, were the most historic years in terms of like number of homes sold. Record-breaking years, 2020 and 2021.
The stats are so weird because it's like there was no supply. Yeah,
Correct.
But everything was selling.
Yeah, so maybe I talk about the lack of supply and underestimate the lack or the intensity of the demand, right? Mm-hmm. Is maybe more of where that story comes together.
Sure.
Ultimately the supply thing, it all adds up because nationally, homes have been underbuilt since the last recession of 2008 to the tune of like 1 million, give or take, a year since that period. So we're talking 12, 15 million homes that haven't been built, that typically are built, right? And it's not like the population's dwindling.
Right.
The population, like, if anything, it's growing because now, the millennial and all these younger generations are a driving force to demand because they're on TikTok or whatever, and they're smart, and they're seeing how powerful owning a home can be compared to renting, right? Mm-hmm. So there is some a good amount of financially savvy people out there these days and age. Baby boomers want to downsize.
People are living longer.
Right?
I mean,
exactly.
as time goes on, yeah.
The I don't even know what generation we are, and what's above us is trying to move up into the baby boomers' house, but they can't go anywhere. So it's just a big log jam right now. Mm-hmm. So
it's not like overnight they're going to build 15 million houses. It's that the supply is just not.
Yeah, it's not how it works. The demand has been so high, and the supply has been so tight that even when the demand has a huge hit in a short period of time, it's not cured in terms of being balanced, or in terms of the market favoring sellers. Still, there's still not enough homes to feed the demand that's out there, even with the demand being greatly affected by double the interest rate.
Yeah, I mean, the beauty about real estate, with everything we're going through, it's still a good time to sell. And if you're a buyer that needs to buy, there's still opportunities, and that's pretty much always the case, right? Every market.
Yeah.
Find opportunities and make it work. That's why people will always be buying and selling real estate. It's not going away.
People are always going to have babies. There's always going to be marriages. There's always going to be divorce. There's always going to be death, unfortunately. There's going to be situations where people just have to move, right? Not even have to buy, but like having to move.
Just their needs change.
And from that's the word, need. Like you need to move. Your job relocates, right? A bunch of examples. And then there's the wants, too. And I think a lot of the last couple of years has been want-driven.
Yeah,
because the affordability aspect with the low interest rate allows that to happen.
Yeah.
I do think there was a big impact from COVID of people being stuck inside their home for those 3 months or however long it was.
More with their house.
Where it's like, I don't care. Even if this is never going to happen again, like my eyes are open, I'm getting the hell out of here. And I don't care if I have to pay $90,000 above what makes sense to get this house that I want. I can do it now because of a lower interest rate too. Yeah. So I think a lot of the last couple of years has been want.
Well, a lot of people are working from home more still now, right? So,
sure. Yeah,
I mean, your home is very.
I think there's a scab, so to speak, from COVID that hasn't, fallen off yet.
For everyone that went through it, I don't.
Yeah.
It's like imprinted in your brain.
I think
now,
that's.
Right? I mean,
that's what I wanted to get to. It's like I don't think that really changes in the next decade or so.
No.
So it's going to take until all the people that have lived that
forget about it,
get happy with their situation and forget about it. Yeah. And the younger generation, like our kids' age, they're not going to really reflect on it that way. Probably. It's going to take a lot to change that.
Yeah, for sure.
So. you mentioned a good time to sell. If anything, it's like in the last few years, the most ideal time to sell, because chances are you have to buy.
Well, if you had to buy something else, yeah.
Which is, generally speaking, even if you're relocating out of town, most of the time, right? Like most of the time, people have to make a move into another house. Don't get me wrong, there are cases of making a move into the nursing home or whatever, right? Sure. But, that's usually the case. So
you live somewhere, you have to go somewhere else.
Exactly, right? So now you can still sell your home for a great number. And that's what we're seeing right now is, I guess, the message I would give on the selling side of the equation is like, we haven't seen prices drop much, if at all, right?
On certain houses, not at all.
Everything's situational, right?
Yeah, definitely. It's a lot more situational than it was.
And my take is like, right now, June 29th, 2022, and I do expect this to change, but not to the point where there's a crash or anything. We're still getting the same numbers. We're just doing it with a lot less demand driving it there. So the demand that either needs or wants those homes is still showing up to keep these sellers happy with crazy numbers in play. Mm-hmm. We're just, instead of 40 offers, literally, which is what the last couple of years has been like, now it's 5,
right,
10.
It only takes 2 to bid it up to some crazy number.
That's kind of what we're seeing. So until the demand side really changes their attitude on things, I guess sellers are still in a premium position, and now just in theory and it's holding water, they're gonna have an easier time buying.
With less competition.
Right.
I mean, it is a kind of an interesting little pocket that we're in right now.
Yeah. And this is where it's like, I'm really curious how this fall goes, because that's when our seasonal period is anyway. Mm-hmm. And, does the negative news in the economy just continue to evolve and not get any better? And is that, really when like real estate really starts to truly shift? Right now we're just shifting.
Yeah.
Cooling. We haven't.
It's important to know that you can't just take every news article headline for face value either.
100%.
Because there's going to be a lot, there already is, but there's going to be a lot more stuff hitting the news articles that are very scary that may not apply to, that won't really apply to the average buyer or seller.
Well, 100% on any topic, right?
Yeah, for sure.
Relative to real estate, like, so I touched on it earlier. Here's a statistic you're going to see on the 2022 real estate market. Down, 11%, whatever it's going to be. Okay, we don't know right now. Keep in mind, that's down 11% from 2021, which was a record-breaking year.
Way up. Yeah.
Right?
Yeah.
So, and keep in mind, even before that, I didn't mention this earlier, 2017, 2018, 2019, those were, if not record-breaking years, pretty damn close to it, to the all-time highs. Mm-hmm. So we've just been, real estate as a driving force for the economy as a whole, and the number of dollars that are traded back and forth, right? It's just been crushing it. Mm-hmm. For the last 5 years.
Yeah.
So when you see the news headline of like 2022 real estate market down 11%, that doesn't mean like we've just taken a step back in 1985. Yeah. It's just, okay, we're kind of normal for what is intended at this point. Mm-hmm. And I mean, I say hopefully balanced.
Sure.
Buyers can buy, sellers can sell, everybody's happy.
Yeah.
You can move even if you want to.
Yeah, for sure. Yeah, one thing that I saw was something with a head guy at one of the online foreclosure auction type websites. He's like, you're going to start seeing these articles saying that foreclosures are up 700% or 1,000% or something crazy, and everyone's going to get real scared that there's some crazy crash coming on. You got to remember, during COVID, you couldn't foreclose. There was
'cause
zero, almost,
they were
not
down
quite zero.
695% the year prior.
Yeah, right.
Yeah.
And this is what the news article, the news, this is what they do. They want to catch attention. And there's going to be more of that stuff, I think, that are going to come out and be real scary and make it seem like the world is ending with real estate, but it's not.
Yeah. Don't get me wrong. Buyers, I get it. Like, it's painful when you have the perspective of what the rate was 12 months ago compared to now, but.
Sticker shock. And,
sticker shock. So boil it down really, like, what do you need to do? Let's act accordingly based on that.
We'll make it work.
Yeah.
Whatever your situation is, we can make it work in any market.
Yeah. I feel like that was a lot of rambling, but good information. We'll be more consistent with these, at least quarterly, to just, hey, here's the state of the union, what's going on in the real estate market, what's going on in the economy as a whole, because it's important. We're in turbulent times right now. Mm-hmm. Now, hopefully when the history book is written, it's not like a significant chapter in the grand scheme of things, but, compared to what it was, it's definitely different from 6 months ago and a year ago, certainly. Yeah. And it's different from 3 months ago, too. So, and 3 months from now, it's probably going to be different.
Yeah,
so
I'm sure it will be.
Stay tuned. Hang on.
Yeah.
All right, great stuff. Steve Bentivegna, Anthony Butera Team, joined as always by Jason Mancuso. Appreciate you guys tuning in. Thank you.